In episode 114, we discuss key trends of the UK property market in 2021. In the middle of the pandemic, house prices are at all-time high. First-time buyers have been in a frenzy to secure their first home, and we've started to see a trend of Londoners buying outside of the capital. We dive into these events and much more, covering why it happened, what we think will be the impact in the coming year, and some of the behavior changes we expect to see from buyers, sellers, renters, and also lenders. We cast our predictions for the UK housing market in 2022, where we see the biggest opportunities and risks for everyone to consider. We also share our personal views on what we would do in today's market if we were starting out. If you're an investor in property or you're looking to start this year, this episode will definitely serve you well.
Take off, take flight with you. For we never fly, but we're flying.
Okay, guys, welcome back. Episode 114. This is the second episode of the new year, but it's the first episode as us together as a collective. First, start by saying Happy New Year. How's everyone doing? Let's collect some sort of experiences over the New Year's, and then we can dive into today's topic. Olu, please talk to us about your New Year's.
Good. Spent it with family, which was really good. I think it's great to be around Christmas during the holidays. It gives you that sort of that joy, that excitement. So I spent it with my family, my two younger nephews, and just the excitement that they have celebrating Christmas, spending time with family, playing Ludo, playing IO. It was very competitive. We even played Monopoly until like 2 a.m. It was a very competitive holiday festive period, but it was fun, right? It reminds you of the importance of family. To a lot of our listeners and a lot of people in the world, right? They might have lost family during the sort of pandemic period. So obviously condolences to those listeners, but it just reminds you again of the importance of family, right? So it was good.
How many games did you win? Because I know you're, especially Monopoly.
Nah, Monopoly, I didn't even win that one. It got to a point where it was 2 a.m. and we were just like, oh, let's count our money. And I'm like, that's not how the real world works, you know. I can still come back.
Net
I
worth
can still
discussion.
win this. But yeah, it was very competitive. It was very competitive. Wasn't keeping track.
Cool. Shuel, how
Yeah,
was your New
good.
Year's?
It was good. It was great. Went to Miami. Great weather. Great food. It was actually relatively chilled. It wasn't a crazy party thing. More of like a chilled vibe, I would say. But no, great food, great company. Um, it's crazy actually. The older that I get, my perception of America changes more and more. And every time I go there, I just come away from it thinking that there's so many business opportunities out there. There's so many opportunities to grow. There's so many opportunities to scale things. And yeah, it gave me a lot of personal reflection for the year ahead. So yeah, I'm fresh off the plane as recently as today. So yeah, looking forward to having this conversation and kicking off the first Take Flight podcast episode for the year
Yeah.
as a group,
When are you
because P did a great one as a takeaway.
when are you relocating to Miami?
Tackle that offline. Tackle that offline. Daniel, how are you doing?
Yeah, I'm doing good. I think the last time we recorded, we met up. Well, three of the four of us met up in person. So that was Joelle, Olu, myself. We went for a nice lunch, Sushi Samba in Heron Tower. So that was nice to just meet up and to chat and converse over a nice, salubrious, hearty lunch. But over the festive period, it was nice. Spent it with my wife, saw some family, but very much just been been at home, just relaxing. I've had a few weeks off work and just really enjoying the down period of resting and recharging. So I'm really enjoying the period that I'm in and gearing up for a impactful, fruitful, and challenging in a positive way year ahead.
Love it.
I was telling Daniel, man, we really need a company jet because I could have made that, but we just don't have the resources. I could have made it for that meal and then back with the family the same evening. But I think one of you guys posted, I think the meat, and I said, yo, and then I called Daniel. Daniel explained to me what you guys ordered, and I just thought,
We had to actually order it. We had to order it twice because it wasn't
yeah, I
enough.
heard. That's
As
what
you,
you're
as you
telling
can
me.
imagine,
Yeah, that's what
because
you're
we've
telling me.
got some big boys around that table.
No, all good. Yeah, and then myself, no, great. I think sometimes you just got to sit back and say, life is perfect. New Year's and Christmas period was great. We moved into a new place. Just thankful, grateful for the year, the opportunities, health, especially in the current period that we're all in, and just looking forward to doing it all over again next year. So it was it still is a good break. I'm not back to work until next week. So yeah, good. No,
Great.
guys, perfect. Thanks for sharing and checking in. Really looking forward to today's discussion. Today we want to dive into the current state of the UK housing market, talk a little bit about how we see it for this year, 2022. And I think it'll be quite interesting because we all have a vested interest in this space. So it'd be really good to get your thoughts and ideas as to how you see things, right? So before we sort of dive into maybe some of the key trends, key topics, I wanted just to sort of share a few, record numbers, some stats around 2021 with relation to the market, just to set the scene for the audience, and then we can sort of dive into a little bit more around those pieces. So very first thing, right now as we speak, the typical British home, the average price is actually at a record high at £255,000. As of December of last year, growth hit double digits, so just under 11% at 10.4%. This is the fastest pace of growing since 2006, just to put into perspective. And then within that, one of the things that came out of it actually was Wales topped the charts at a 15.8% growth versus last year. So we're seeing record numbers and waves in this market compared to previous markets. One of the things that was quite alarming is that Londoners have actually spent a record number of £55 billion outside of the capital. So looking to invest and buy properties outside of London. The previous record was actually 37 billion in 2007. So it just speaks to the volume of transactions that are taking place outside of London. We'll get into sort of why that's happening. That totaled actually 113,000 properties. And I think we've also seen extremely low interest rates, sub 1% from some lenders. They say actually now the average deposit for a home is around £88,000. So again, alarming numbers. And I think the very last thing which we can dive into is obviously the stamp duty holiday was a big topic, and that actually amounted to £6.4 billion that otherwise the taxman would have received. So a very unique year for the property market, record numbers in some areas, and I think changes that will impact the housing market for many years to come. So it's really about, getting your thoughts on why that's happening, right? And we can sort of discuss and share the key trends there. So who wants to kick it off with just sharing, how they've understood the 2021 market? Dan, go ahead.
Yeah, I'll start. I think you shared some interesting figures there about how the growth, the annual rate of growth has been 10.4%, the fastest in 15 years. And as you mentioned, that £55 billion has been spent outside of the capital, resulting in 130,000 properties. I think it really comes down to one thing. I think it's been it's been a year of growth in many areas in the industry in different sectors in 2021. As we saw the knock-on effects and ramifications of the pandemic primarily happening in 2020. And when you think about why people are looking, or why there's been so many houses bought outside of the capital, I think it's people and buyers becoming weary of the lockdown and stepping up a lot more spacious properties outside in urban areas with more room to work from home. I think that's been maybe one of the key themes that could be seen here. And that trend is likely to get tested this year. As you mentioned, rising borrowing rates, stretched affordability, and pinched household finances come into play when you look at electricity and gas prices being at an all-time high, inflation growing rapidly. So I don't want to jump ahead from in what we're going to discuss today, but I think a large part of this growth, this rapid growth, the highest we've seen in 15 years, is due to the pandemic and lockdowns.
Definitely. Sure.
Yeah, so just I mean, I'm pretty much looking at the same variables that Daniel had mentioned. I think, of course, the stamp duty probably played a part, but I think the bigger factor was the fact that everyone was stuck at home and probably thinking about Is this an area that I want to live in? And is this the type of home that I want to live in long term? And probably they've been thinking about years about moving, but this was probably the jump they needed. And I think in parallel, they were probably being offered money cheaper than ever before. Rates, I know we'll probably talk into it a bit more later on, but rates are probably at their historical lowest. And then people just weren't spending as much because they were just spending more and more time at home. So I think you put all of those factors together, then suddenly you've got a very buoyant housing market where across the board people were probably looking to invest and buy bigger or buy larger or invest as an asset. So I think all of these played into the hands of people with an asset, and then I guess we'll talk about later on if we were to start again, what would we do in the
Mm,
current climate? But yeah.
yeah. Olu, maybe just some reflections from your side.
Yeah, not try not to repeat what the guys have said. I think trying to understand what the impact of the stamp duty holiday, I feel like it had maybe not so much of an impact on the market, just due to the fact that we saw
Interesting.
growths in other countries which didn't have stamp duty holiday. So how could it be explained the growth in the US and other places when they didn't have a stamp duty holiday? So when I think about it, I think more around the money that was printed and put into the market. So when money is put into a market, it needs to go somewhere. Either it's going to go into, we've seen it come up in inflation. We've seen it with spending. We've seen it in the stock market where it's gone up in value, and we've also seen it in the property market, right? As the pandemic forced a lot of people to save, you were able to then, and because of the furlough schemes and getting more money through those sort of things, it allowed more capital to then be used for purchasing properties. I think what would be quite interesting is to understand how many people purchase properties with a residential mortgage, or how many actually purchased on a buy to let, so investors. And I think a lot of the me personally, I think a lot of the increase in price was really driven by investors. Um, you started to see companies like Lloyd's say that they're going to purchase, I think, 50,000 homes
Hmm.
in the next 10 years. You saw lots of different private companies coming in saying that they're going to purchase homes as well. And I guess a lot of us that have been purchasing or were purchasing in the last few years can share experiences of trying to purchase, right? I remember calling up an estate agent um, like a day after a property was posted, and them saying to me, "Oh, we've already got 30 people booked for viewings. Like, we're not taking any more viewings." So you're like, "Wait, that's kind of crazy." And I think a lot of those people were investors, right? It was people looking to purchase outside of London. So, like myself, I make my money in London, but I was looking to invest up north. So it just goes into that supply and demand conversation that we always say. And I think with that whole calculation of supply and demand, you look at affordability. I think there's more money in the market, like I mentioned, so people can afford better homes. Interest rates are a lot lower, so banks are giving better rates for it. And then demand element of it, we all know in the UK or in most places, there's a limited supply of housing, which then drives up the prices. So yeah, that's what I've been
Yeah,
thinking about.
no, I think great conclusions from you all, and I think we can unpack some of those pieces. One of the things I wanted to spend just a little bit of time on, because there is this perception that the house prices today are basically driven entirely by, or people feel that way, the stamp duty holiday, right? So that's kind of this sense out in the market. So I'll just talk a little bit about what stamp duty is. It's just in effect a form of a tax charge on legal instruments within the property space. And the whole story behind the stamp duty holiday was that in July of 2020, it was, and I guess it was a way to stimulate the market. Um, they basically said properties purchased of a value up until 500,000, half a million, there will be no stamp duty tax on. And it depends obviously at what price there's a certain percentage applied. So that was basically to be in place for a year. And then in 2021 of June, it was then reduced to 250,000, and then it concluded in October. So there's this sense, there's this real belief, but I think a lot of people that we are where we are today because of the stamp duty. And I think some of you guys have mentioned, actually, that's not quite the case, or there are other factors that have played a role. So, how much do you think the stamp duty has played a role? Um, do you think first-time buyers have actually really benefited from there not being that stamp duty tax? And what are the other key factors that you guys have mentioned that you think have played more of a role to where we are?
Well, that's a very good question, and it's something even as I'll drive around in the last year or so, is I think there are other factors that come into play. I think the stamp duty holiday may have accelerated people's wanting to buy a home to take advantage from a huge tax haven. That's a no-brainer. I certainly would want to take advantage from that if I was in that situation. But also, when you think about other factors that may have a part to play during the lockdown and during the pandemic, or various lockdowns and the pandemic as a whole, people may have been in situations or environments that weren't conducive. When I say that, it could be that space could get tighter. It could be that they're with their significant other or spouse, conversations, arguments increased and were amplified. And we've also heard before that statistics of the rate of divorce increased during the pandemic because people weren't so used to being in a confined, constricted space with their significant other for long periods of time. And unfortunately, the effects of that is a lot of people separated or may have divorced. So when you look about people buying, they might not be the first time buyer, they might not be a joint buyer, they might be single, people buying by themselves, or people selling their homes may have been because they're divorcing, they're separating, they now to put their family home up for sale and they're moving elsewhere. So in our area, I'm not saying that this was the case, but in our area, we just saw a lot of for sale signs popping up. I don't live inside of London. However, a lot of people see it as a commuter belt region. So people would live where I live and get a train into London. And as we mentioned earlier, people are moving outside of London to take advantage of more green space, more open space, and more favorable working from home conditions. So we saw a lot of properties up for sale. Whether people moved from where we're living, we don't know. Maybe they could have moved further afield, further up north, further down into Devon, Cornwall, etc. We don't know. But we definitely did see an increase in number of for sale signs, as well as sold signs. People were snapping them up left, right, and centre. So I think there are other factors to play that come into play when you think, what could there be, or what could have driven this fast rate in house, this increased rate of growth. And I think those themes, those things shouldn't be overlooked because I think they may have a huge part to play. And just quickly mentioning on the renters market, we know at the beginning of the pandemic, landlords were somewhat, or it was said in the media, landlords were worried about having their tenants stay. They were trying to lock people in for a long period of time. Then about this time last year in the summer, it completely flipped on its head where they were able to even charge maybe up to 3 times the amount per month on what they were prior to the pandemic. Even when people were trying to get a place, secure a place, pay a deposit, it was often heard that there are 10 other people wanting to see it, or this person's willing to pay 4 times the amount per month just to get that room, just to get that apartment. And it's really crazy how things change in a matter of months, even in the renters market, let alone the buyers market.
Yeah, no, and just that one point on, I had a couple people actually in the property space, agents, telling me that one of the patterns that they've seen is, to your point earlier, Dan, is if they don't love their house during the pandemic period, they actually hate it and they're looking for something else. So bringing it back to that stamp duty point, the more and more I was looking into it, because I actually thought it was a big driver behind the volume that we see today. The more and more you look into it, the more and more you realize actually there was a part in as to where the stamp duty holiday was really there to sort of protect some of the jobs in the property market space. And they did an analysis to basically show there wasn't much of a correlation between the areas that you would expect to see benefited in terms of the ones up to 500,000. There was no correlation between that and the stamp duty holiday. And a lot of the transactions were actually, well, quite a lot of it was actually 1 million and over. So what the consensus around stamp duty holiday is the sole driver. Actually, when you look into it, not necessarily so much. The other thing I'll add, which I think is interesting, is I think it was a year where first-time buyers really had an opportunity to, or they feel like an opportunity to secure their first property. did they really benefit? What they would have perhaps saved on the tax, I think they would have paid for in the actual price because you saw the pent up demand. Um, so yeah, just interesting on that take. When we look at interest
It's
rates, go ahead, Olu.
but
Sorry.
just so what you mentioned, I think is great. I was just whilst Daniel was talking, I was looking for some data in regards to understanding what was the mix of first-time buyers to buy-to-let investors, and it showed that 50% of the mortgages were actually to first-time buyers in 2021, which was the biggest increase they've seen since 2006. So it does look like a lot of first-time buyers did go into the market, maybe due to the stamp duty holiday. But like you mentioned, I think, which is the important thing, is did they truly benefit based on it?
Mm,
Because a lot of times they were paying higher prices versus last year more than what they would have saved in terms of the tax element. But maybe it's just it's one of those things that's mentally right. A lot of people are like, oh, mentally I don't have to pay any taxes here, but not really thinking about, okay, how much am I paying for the property? Because at the end of the day, you can't control the price, right? You When you're ready to buy, you've got the money. You can't control that the price is at this amount. You can't really wait for it to drop.
yeah.
Yeah, and it could even be a case that there were many people that were looking to get onto the ladder, but thought, okay, I haven't really got any. There's no fire under me to push me to do so. But if there's a stamp duty holiday, I've got the money right now. We're in a pandemic, and I probably would want my own space, and I have time to actually enjoy it. Now's maybe a good time to strike whilst the iron is hot, possibly. But like you said, a monetary saving is always looks good to the eye, but there's no such thing as a free lunch.
100%. We saw one of the other key trends was a really competitive space amongst the lenders. You have, interest rates are all time low, and I think that played a key role in just, wealthy people understanding that they can borrow money cheaply, as some of you guys have mentioned. Any perspectives on that? And I guess, you know, you know, how would you guys look at that, right? If you imagine, put yourself in a position where you're even a much more experienced investor, the opportunity to get properties at a sub 1% on a residential mortgage, you're really going to take advantage of that. So yeah, but any thoughts? I don't know, Shuo, on just the interest rate space and how lenders have kind of behaved during 2021.
Yeah, so I think for me personally, I mean, I've gone through a journey where we've been looking at purchasing a family home, and initially the driver for purchasing a larger family home was we haven't bought a home. The home that we've been in, where my parents have been based, we've had it since 1997, so it's quite a long time, right? And then the initial driver was the actual stamp duty holiday. So we thought, okay, we're looking at houses probably between the 700 to a million range. So that's quite a sizable saving that I could do. So then I was like, okay, cool, let's do it. We'll put it under my name and we'll build from there. And then as we looked through the market was so hot that everything that we wanted was almost gone by the time we've gone to view it. The day that we're viewing it, 8 other families are viewing it. And then every offer that's being made is above the asking price as well. And in the end, because it's such a sizable transaction, we didn't want to move anywhere until it was the perfect place for us. Now we were fortunate that we found the perfect place. It was on the market for 725, and we ended up having to get it above the asking price. But that's just the market dynamic now. And then, unfortunately or fortunately, the timing of it, this happened after the stamp duty holiday anyway. But then by that point, we were so committed to making the move. I think, like many others, we thought, okay, let's just go and move anyway. And I think the drive, and going back to your question, Pete, one was the house itself, but then also the rates that were on offer. So I was offered a rate that was much better than the rates that I was getting as I purchased through a company, for example, as an individual. And I've never seen rates that attractive before.
Mm.
So for me, that was like, okay, well, if I can get the rate like this, lock it in for 5 years, and it's an asset that will only be, I think, that type of the market as well, where people growing families, if the incomes are rising, then these are the types of homes people will always want to move to. The demand will always be there. And in the area that I'm investing in the last 8 years, that type of home has increased the most as a percentage, around the 80% mark. Then that's why I was like, okay, let's really go for it. So the interest rate did play a factor there, despite the fact that I had to pay the additional stamp duty in the end. So
Yeah, no, no. Thanks for those real life insights, and I just think I think we've been in actually circles, some of our property investment circles where we've heard of, let's say, the experts really taking advantage of this period where they're basically borrowing money cheaply. And then if you can look to find a higher return on investment elsewhere, it's kind of a no-brainer, right? So I guess the question is for some of the investors is how much did they really gear up by and leverage. So I think we've accurately spoken about the key trends that took place last year, right? You've got a shortage of homes, which has always been a sort of a characteristic of the UK market, plays a role. Low interest rates, stamp duty holiday, and this COVID is playing a role in terms of Londoners buying outside of the capital. How does this start to shape up the market now for this year and beyond, right? Because we started property prices. These prices are all-time high. Do they actually reflect the real value of these assets, or are people sitting on portfolios that are worth more, that they think, yeah, it's worth a lot less than what it says on paper? So how do you guys see the growth, and how did you guys do you think there'll be a sharp correction? Do you think there'll be a correction in general, or do you actually see this continuing because maybe Omicron can maybe kick off another pandemic wave? So thoughts on this year?
When you think about it simply, if demand is not jokes aside.
You're being
When
serious, I know.
if there's high demand, the prices are going to stay or only increase because there is demand. We know the saying, elasticity of demand, supply equals demand. If there's demand, there's going to be a high price. We know there's a low supply, which means the demand's already high, which is only going to further inflate the price. If we see a continuation of new variants being introduced by, we've been informed of variants being introduced by COVID, we're likely to see a continued rate of where we are now for a longer period of time. Your question is, are people sitting on portfolios that may be inflated or not be a realized value of what they are? There's a chance that is the case. That percentage of what that value is, we don't know. I'm not an economist. I'm not a housing specialist. I can't speak for the UK as a whole, but it's likely that if there is high demand and prices aren't really reflecting it, then of course it could be that those values are not correct. But how do you adjust for that? You can't, because we don't know what that correction would be or can be, or if there's going to be correction.
Daniel, the way that you set that up, Daniel, I thought you were going to do another play. But I actually, just a quick one, so I can just to build on your one, Daniel. I think to P's question, whether there'll be a correction or not, I think the question is really when it will happen rather than if, because just historically, whenever anything has been at an all-time high, whether it's property, whether it's cryptocurrency, whether it's Dogecoin, whether it's Bitcoin, wherever it is, there's always a correction of some kind. So it will come. But then I think this goes back to your personal investment philosophy and the horizon that you're looking at. So if you're looking at this from a 5, 10, 20 beyond year horizon, then whether correction comes or not long term, as long as the fundamentals are there, population growth is increasing, the number of people renting homes is increasing versus buying homes, incomes continue to grow, but just not in line with housing prices, then I think there will be demand there. So I think long term, you're in a safe space with real estate. But then when that correction comes, that's probably the $1 trillion question. If any of us knew that the answer to that, we probably wouldn't be in this call right now. But it'd be good to.
I think Olu do. I think Olu does. That's
Yeah,
what
all
he's
right,
going.
Alu, give us your crystal ball prediction. Is it in your logbook?
So no one knows the time of a correction. Do I believe that the market is overvalued? Yes, I do believe the property stock markets, I think all the assets are inflated at this particular time. But I think the more important thing is, how do you protect yourself? How do you invest in a inflated market? Because the answer is not investing, right? Because things are going to naturally go up. Is how do you protect yourself investing in inflated market? So I think there's a few things you need to think about, right? Is if you look at previous the crashes, so the last one I can think of is like 2007, 2008. We're in a completely different time. I don't believe back in the day the banks didn't have the same regulation that they have right now in terms of affordability. Right now we do, the banks are on top of it when it comes to affordability. So do I think we're going to get a mass amount of foreclosure in properties? No. So it's not going to be a situation where there's now going to be a large amount of supply and available properties, which will drop the price. Now, the next question you got to think about is, if there is a correction, whenever this correction is, roughly how long will it take for it to recover? With every every correction or reduction or crash, whatever you want to say, there's going to be a particular time frame for it to recover. If I think about 2007, 2008, it took 7 years for it to rebound. So if you're someone but purchasing a family home, or you're like P, who's never going to sell any of these properties, right? Does a decline for 7 years really matter? No. He's still getting the cash flow from those properties, unless, as long as he's made sure that his loan to value is in a reasonable place. So when he has to remortgage and those situations, he can still do it and afford it. He doesn't need to sell. And then he can also pick up properties at a lower price during that cycle. So, like, valuations don't really mean anything until it's time to sell, right?
Hmm.
And
Hmm.
that is all about how much can you sell your asset for. So, like, whenever I look at like prices, I purchased a property for just under 80K. I see a property four doors down now on the market for 120. It's not going to be sold for 120, like, and but that person is putting up for that value, right? So
How do you know?
there's
You hope
we'll
it
see
is.
how
You
long it
hope it.
stays.
You hope it sold for 120.
I hope it does, because then I made a nice equity gain. But I think the key thing is that, depending on what your strategy is, it doesn't really matter. Now, if you're someone that's, the people that need to worry about this question for me are more people that are flipping properties. So people that are doing renovations and flipping properties in a short period of time. Now, within those, that's more high risk, because you're thinking about, okay, if I purchase this property with the intention to sell next year, what is the market going to look like next year? It's very difficult to predict. But if you're someone that's buying as a family home, or you're buying it as hold investment, like a generating wealth and hold for long term, I think you have less to be concerned about. And you just need to focus on affordability and getting the best for your money. So looking for value within it. So there's lots of different techniques people say is, find the worst property in the best street and then build and improve those properties, right? Not trying to buy the best property on that street. So yeah, that's my view on next year. I don't think you could predict. Oh, the one other point I wanted to really mention is, you don't you typically don't see continuous all-time growths. So what that means is, we've seen 10 to 15% growth in the property market. Typically the next year you're not going to see another 15-20%. Same with the
Hmm.
stock market, we've seen 27% increase. Typically the next year you're not going to see the same growth. So I do believe, even if we don't see a correction, the likelihood is we're not going to see yearly growths like we've seen this year.
Mm.
And there's lots of different charts that you can look at where it has annual growth of properties, which will show you that in record breaking years, the following year you're looking at either a negative or close to 0% growth, and then slowly maybe going up again. So I don't think we're going to see record double digit growth year over year. I think that's the key thing to think about.
Yeah, no, I think we're all aligned. I think it's a question of what kind of correction do we, what type of correction do we potentially see happening. I think it'll be more, I think there'll be a bit of a spillover effect from last year, just because the demand kept on going even after stamp duty holiday completely closed. I think there will be a cool down period, um, but still expect activity within the market. But then at some point, I'm also asking myself, I mean, how many buyers are there? Right? I'm hoping myself actually it's not as competitive as it was last year. So we'll see, but still going to be a growth. I think one of the things I'll say before we look at opportunities and risks, I think some of the things that we've spoken about speak to why it's quite important to be part of this investment asset and vehicle, right? Because especially in the UK, supply and demand will always work more primarily in your favor. You've got these cycles that happen every so many years, and if you just sit and hold and sit and wait, right, you just basically gain over the long period. So it's it's also been quite a reflective period for people that have portfolios to look at what's been happening in the market.
I
Um,
was
Go
just
ahead.
going to add to that, B. Something that the chief economist at Nationwide said was, it appears likely that the housing market will slow next year, as in this year, 2022. Even if wider economic conditions remain resilient, higher interest rates are likely to exert a cooling influence.
Yeah.
Affordability is already less favorable than before the pandemic struck. So it's,
Yeah.
it's there.
And I think on that interest rate point, I think the Bank of England just before the year close rose base
The
rate to
MCP,
0.25.
yeah, the MCP on the 9th of December, yeah.
So that's a reaction to the increased inflation, which should in turn slow down the pace at which these prices are rising. Um, yeah, so I think that's an interesting point to mention. I think the other thing also going back to, I think if you have a property today or two or a portfolio, what's quite reflective is we've seen inflation. They're even saying I think inflation is expected to be around 6% soon. That property is a good hedge against inflation. So there are some, as much as sometimes it may seem like within a record year of property, there are some reflective learnings on the benefits of holding. I want to get your thoughts on opportunities and possible risks for 2022, right? What do you guys see as, and not necessarily for us as, but just in general as a property market? Any thoughts? I think maybe one I'll just share from my side. I think there's an obvious opportunity. Well, you have to obviously know what you're doing. You have to be educated and an expert. Everybody's kind of ran away from London, quote unquote. So you've got all these empty offices, and I think one of the questions there is who's going to come in and maybe look at the next use of these offices, right? Convert offices and maybe to residential spaces, or convert offices into maybe, I don't know, spaces that can be used, maybe even from a virtual setting. So I think opportunities around what to do with offices, especially in the London space, could be quite interesting, and something that we hear more about throughout the year.
Yeah, P, for sure. Commercial to residential conversions are a big thing where there's a lot of reliefs that you can get, tax reliefs that you can get for doing those conversions. And as we mentioned, I can speak for my company, right? We've given up our office space to go to a smaller sort of WeWork style hot desk versus a larger commercial space. So I think that's
Mm,
one definite opportunity. Um, I do believe there's still opportunity outside of London. Um, just in regards to, I would always say purchasing now is better than waiting to purchase in the future. So, what I mean about that is if you're not able to afford to purchase in London, trying to save, you're never going to save enough to meet the appreciation of the assets. So even if you're trying to say, "Oh, I'm going to save for 3 years," by 3 years you're going to realize, "Oh wow, that property that was 300k is now 400k." If you look at London, 400, 500k, right? If you look at London, so in some circumstances, it might even be better to still use that money to invest outside of London, up north. You can purchase multiple properties there, and then over the maybe 2 3 years that you're waiting, those have appreciated maybe not so dramatically, but you could then sell to be able to purchase in London if your overall
mm,
plan is to move back into London. But I would always say you, I personally never like to purchase the most expensive property in the street. There's ways to look at it, right? You can go on comparison websites. I don't look at the estimate, right? There's been a lot of companies that have got in trouble for estimating high property prices. I look at what a property sold for, right? That is the key importance to say, okay, I saw this property sell for 100k, so now that's now like the base value of that particular area. If you see multiple properties selling for 100k, then you're comfortable that that's a good valuation for that particular area or property. Um, uh, I know we're talking about properties, but for me, I think there's an opportunity to look at maybe other asset classes. I think you should always challenge yourself to say, okay, is property the right place for me to put my money? Um, because if this just like now that the taxes and elements are there, maybe you might consider stocks as a place to put your money. I think P and I have talked about a play where you put your money in stocks for a particular period of time. You might wait for the market to quiet down as the stock market increases. If you put in the S&P 500, you can then pull that money out to then go back into the property space. So those are some of my thoughts.
Yeah, great takes. Shuo, Daniel, opportunities and risks, or
So
could just be one or the other.
So I'd do it very quickly. So I think opportunities, just from my personal perspective, I think as property prices continue to increase, yields just get even more squeezed. So yield just meaning the rental incomes over the price of the asset. So I think that means that the bigger opportunities will probably be in HMOs, in multi-unit property. So I think there's an opportunity there, and probably at that segment of the market there'll be less buyers. So I think there'll also be some opportunities to purchase larger assets for better yield. And I think specifically in the HMO market, I think we've all seen the types of products that are available there. But I think if you have a good quality product which stands out versus the competition, I think there is an opportunity there as well. And then on the flip side, the risk where I see it for me personally, of course, with all these inflation, which has had a positive impact on the assets that all of us own across multiple different classes, the risk is with projects and refurbishments and stuff, all those costs have also increased as well. So I think there's an element of risk there that those costs need to be managed. And then, of course, delays, supply chain issues, these are also knock-on effects that can have as well. So those are the opportunities and risks that I see, but overall still looking to invest this year.
Sure, you just reminded me something when you mentioned that. Let me just add to one point is one of the reasons why property prices are so high is the cost to build a house from scratch. And I think we haven't really discussed that. With such an increase in material costs, like the cost of timber and the cost to create a house from the ground up, that's why we've seen such a high value on properties that have already been created or already exist. But yeah, that was a great point, sure.
Daniel, just maybe some thoughts.
Yeah, I was just going to share something you said earlier, P, about office spaces in the city. And just to that point, I wanted to just give some facts for that. So the City of London Corporation, which looks after the square mile, which is a square mile within London that looks from London Stock Exchange all the way to Hackney. It's not 1 square mile, it's actually 1.12 when you actually measure it, but that's besides the point. But they're looking to create at least 1,500 new homes by 2030. So how they may go about doing that, they may use already office space and convert that. Of course, the whole point is to try and retain and attract new talent, tech-based talent into the city, so that London is still an attractive working location, working hub, which of course will ensure that the economy thrives in the long term. But when you look at opportunities for this year, I think there are opportunities everywhere, to be honest. And I think it's about how you look at it and how you assess it, how you analyze it, and what your personal risk appetite is. So irrespective of real estate asset class, there are always going to be opportunities. The flip side to that, the risks, I see the risks as not diversifying your portfolio. So if you put all your eggs into one basket, I think that's where the huge risk is. As we know, inflation's at an all-time high, projected to be it's projected to be 5% or around 5%
Close
by
to
April.
6. Yeah.
But I think it's actually going to be 6% with the way that the price of goods are increasing and what's in that basket, the CPI. And when you do that, if there is going to be a correction, if there's going to be a crash, rather than have all your eggs in one basket when that crash happens, allow it to be diversified so the impact is less or could be less on a specific sector or industry that you're invested in. Because let's be honest, we saw in the 2008 financial crisis, which most of us were not affected by because we were at university, we were in school, we weren't working. It didn't really impact us like that. So we now had nothing. We can't really say, oh, I know what to expect. But where we had now moved on, 13, 14 years later, if there is going to be some crash, it's going to be huge. And you don't want to be the one holding the bag. That's all I'll say. That's all I'll say, because it'll be rude, it'll be horrible, and it will be tasteless.
Daniel, you believe in diversification? I thought you had everything in crypto. I thought you.
No. I'm an advocate for crypto because I think long term it's going to be an asset class that's going to really change the world. But that said, doesn't mean there aren't going to be corrections and it's going to be a smooth ride. It's going to be a bumpy journey to get there, but doesn't mean we won't get there. In the same sentence, I also say ensure you know what you're doing and diversify your risk.
Yeah,
it's a no-brainer. It's a no-brainer.
Well, Danny, that's almost a little 180 from a couple of episodes.
No. Because it's not saying that we're not going to get there. We can, because from getting to here, you can get there in a straight line, but you also can go up and down.
Yeah,
so,
yeah, of course. I'm with you, bro. Man, I told you, I'm dollar cost averaging crypto twice a month, so I'm there with you.
I can see Olu's sort of chomping at the bits to get at Daniel about his strategy, but just before we go left, a couple more opportunities that just wanted to share before we go to the closeout question. I think there's going to be opportunity for overseas investors. I think simply because they want to make a move that will hedge them against inflation. We saw that trend increasing in 2021, so that could be interesting. There's actually an opportunity for people that if they've got enough savings because of the pandemic to secure what lenders have now created as a new product, at these 40-year fixed mortgages at almost 1% or less. So I think these still might be on the market for a couple more months. That could be a big opportunity. Again, how much you pay for it would be in question. But even going, that's kind of, these are macro, but even going macro, I think there's actually very much a big opportunity for, I'm not just saying this because Olu's here, but the rent-to-rent operators, because you have house prices at all-time high. Guys, don't laugh, I'm being serious. you have house prices at all-time high, and people can't then afford to buy. So renting is going to be much more of a trend than perhaps it was last year, right? And so if there is good accommodation, affordable accommodation, I think that's going to be something that's looked into. So I think looking at macro and micro opportunities, that's certainly going to be perhaps a couple things to note. But last question to close out with, and I think it'll be quite interesting, is if we were all starting today on our property investment journey, given where the market is, given what we've discussed, what would you do? Would you buy? Would you look at other asset classes? Would you, not touch property at all? Would you rent? What moves would you guys make? Olu. And also maybe why?
I would. Oh, tough one. I would probably put more money into other assets outside of property, into the stock market. Reason why I say that is because if I look currently at my mix of assets that I own, the majority of assets that I own, probably 60%, 70% is towards property. And if I look at the growth over the last sort of 10 years, it hasn't been comparable to my stocks, my pension, or my or crypto, what I have in crypto. So personally for me, I would probably invest more. And I was doing some study into like how a lot of wealthy people build their wealth. And a lot of wealthy people build their wealth quicker by investing more into the stock market at their early ages. And then as that grows, they diversify more into then the property space as a protection for like inflation, like we've discussed. And then you've got it generating more money for you. So me personally, if I was an investor, right, not thinking about it as someone that needs to purchase a home or whatever, and even in that conversation, I think P mentioned a great thing about renting versus purchasing, because I think sometimes purchasing your home does keep you locked in and you have a lot of equity tied up. So if I was starting again, I think I would go more heavy into equity markets versus property, me personally.
Okay. Not surprised by the answer, by the way. Sure, go ahead.
I feel like this is going to be another property versus stock swap part 5.
No. I don't think so. We hope not. Listen.
So the question is, would I do anything different if I was starting again now?
Yeah. You got a pot of savings. Prices are where they are. what move you're going to make next, and I guess in the property context.
I guess
So give you
100% Dogecoin is out the window. No, so I think so. I think it goes back to, again, probably your personal investment thesis or what you're looking for. For me personally, real estate was always just to get to a stage where it replaces my main quote unquote income to then give me the freedom to think about what's the big swing or big bet that I want to take after that.
Mhm.
And in the investment area that I've invested in, where it's an area where I know I'm familiar with, I have people here, the growth has been pretty good, I would say. Could I have grown more if I put all of that in Facebook back in 2012? I think that would be obviously a yes. But then having that monthly cash flow and an appreciating asset that has grown, for me to have that security, it's given me a peace of mind that I wouldn't want to actually take away. So I think if I was starting it now, probably what I would do is still invest in real estate, still invest in the area that I'm investing in. I probably would actually invest. Would I invest less in property? Maybe a little bit less, and then more
With the
on the.
yields that you're getting today. Remember that into consideration.
I think if I was looking at it from a yield perspective, then probably I wouldn't even personally bother with buy to let, and I'll just go straight into HMOs based on prices now. And based on what I know now as well. That's probably what I would do if I was staying in the real estate space.
Mm. This definitely feels like it's about to go stocks versus property, part five. Daniel, what would you do? And it could be even as a investor, as a look. Would you buy your home that you're in today, right? Would you wait a little bit longer, or would you then say, let's invest this money instead, right? So no wrong
Me,
answers, but just perspectives.
I would delay it. The reason being, when you look at the rate of returns from 2021, when you look at the S&P 500, it's 27%, up 27%. When you look at the controversial cryptocurrency Bitcoin, 62%. When you look at Microsoft, 54%. When you look at Apple, 37%, Google, 67%, Ethereum 428%, and lastly, real estate's 35%. Not to say no to property or real estate. It would be to say maybe I delay it to benefit from these high rate of returns before now putting it into real estate, just so that I could enjoy the huge growth at this infancy and use that money, use those profits to now plunge into another asset class. That's how I would say it, just based on what the information that's available today. When you look at that longer term, so you look at 5 years, 10 years, those numbers, of course, are going to change drastically. So your approach, your ideology, your thought process behind that may change. And also, we have to plug in those important factors that it's been a different to normal year again in 2021, where there were lockdowns. There's the pandemic continuing. So some of these returns could have been impacted by external factors that we have no control over, that in 2022 and beyond we may not see.
Interesting. Interesting.
What about you,
Yeah,
Pete?
yeah. No, I think for me, as you guys know, I believe strongly in this asset class. I would, I'll be very precise. I would invest in real estate. But the move I would make would be not to focus on London, right? Because I think when you come from London, there is this sort of willingness to get your first property within London. So I wouldn't do that. I would literally then see how far I can stretch my money and look to go out of north, up north. Sorry. And I mentioned this on my social media page. I mentioned that if you're from London and you've got savings, there is this tendency to want to buy close to home. But you might want to consider going up north. So I would, I would definitely do that. I think for me, I've always looked at return on investment as a measure of how well I can sleep at night. So I would probably be aware that the return on investments are not higher than what you guys have mentioned, but I'm still in this play for hundreds of years plus, right? So I would probably the question that would be interesting for me though is, would I buy, let's say at that point in time, two or three properties, or buy two and then use the other money onto crypto? And I think most likely would, if I was starting today in this current trend and how things are moving, still property, but I think it's difficult not to have your eye on things like crypto. Yep, cool, guys. I think it was packed with tons of information. I think great insights as to how we have experienced 2021. I think we've very nicely spoken a little bit about, you know, how we see things playing out in 2022, and we can also revisit this episode towards the end of the year to see how things have actually played out. So yeah, really good. And I think it was good that this didn't move into a stocks versus property part 5. I think there was going to be a couple swings, a couple. It was Ollie was itching.
Yeah,
No,
Olu sat up and then his shoulders.
I
got
didn't.
tense.
I didn't
was
need
like, oh, here we
to.
go,
I didn't
here we
need
go.
to. I didn't need to after Daniel came up with the stats of the returns. As soon as Daniel said that, I didn't need to say anything more.
I definitely get the sense that since that episode, Ollie's been building these muscles in this stock market. So I think he's got more to say. That's what I get. So like I said, Ollie, anytime,
maybe we do a part 5 at the end of the year.
I
anytime.
opened a new Vanguard account, a new brokerage Vanguard account. We'll talk about it offline.
Okay.
We'll talk about some of the benefits.
I'm
of the tax benefits.
I'm all ears.
So thank you all for joining us on our first episode of 2022 as a 4. We hope we have started the year positively for you, and you have been able to take away some gems and some insights on how we view this year when it comes to real estate. If you have any feedback for us, as always, please find us on Instagram at Take Flight Podcast. Alternatively, email us at takeflightpodcast@gmail.com. Until next week, stay safe, look after one another. God bless.
And Happy New Year.
Take off, take